David Garofalo is a longtime mining executive with stints heading Goldcorp as well as Hudbay Minerals. He is currently chair and CEO of Gold Royalty. David, welcome back to Kitco.
Lovely to be here. Thank you.
We're seeing you on good circumstances. We've seen gold has been hitting some all-time highs, and we see that copper has really made a strong move right now. It's a great time in the resource space.
For sure. And I've spent equal amounts of my career both in base and precious, so I'm enjoying both aspects of it.
Well, tell us about what's happening right now. What's making the move right now? Why is gold on its way up?
Well, I think it comes down to continued debasement of fiat currency. And it's been a one-way trade actually over 50 years since the U.S. government abandoned the gold standard in the early 1970s. Gold's gone from $35 to $2,400 plus today. And the U.S. dollar's lost 96% of its purchasing power. And that's not uncommon. That's a recurring theme across all major fiat currencies globally. The debasement of that currency through a variety of circumstances has led to gold doing what it's doing today. But we are in an entrenched inflationary environment, and gold has always been a very accurate barometer of that. I think inflation's here to stay. I think the headline numbers vastly understate the reality on the ground. If you're buying food, fuel, or shelter, you're experiencing double-digit inflation, not the 3 to 4% CPI numbers that are reported by the statistics agencies. And I think gold is reflecting that. And I think gold is reflecting the fact that real interest rates are in negative territory as a result of that entrenched inflation.
We're talking about the metal. Let's switch over to the miners and how they're doing right now. So when I look at the GDX, it's fine, but it's not particularly, when you look at the several all-time highs that we've hit right now as well too, we still see that there's some catch-up that needs to be taking place right now.
Yeah, certainly. There's been a divergence in performance. We haven't seen the leverage to the gold price that equities should be providing. And we're starting to see profitability and margins starting to expand as a result of the rapid appreciation we've seen recently in the gold price. But I think the big overhangs for the producer universe in particular is the fact that reserves have been declining steadily for a dozen years. And that's because juniors have had very inconsistent access to capital. And they're the ones that do all the heavy lifting when it comes to grassroots exploration. They make the major discoveries. The bigger producers build and operate those mines, but they don't discover them. And that's resulted in a 40% decline in gold reserves over the last dozen years. So you have a shrinking pie, and that's led to cannibalization. That's led to merger activity, and that's picked up really over the last 5 or 6 years. Started with Barrick and Randgold and Newmont and Goldcorp, and there's been a proliferation of other M&A activity. And that's because these companies are struggling to maintain their production and reserve profiles. And the lack of discoveries has led them to cannibalize each other.
Talking about the miners right now, when I talk to the juniors in the space right now, and they're talking about they're still waiting for this catch-up right now, they're saying that the catalyst is going to be happening around Q2 because that's when you see these margins that are really going to be kicking in. These high gold prices are really going to be kicking in for the miners.
Yeah, that's trickle-down economics. I know the juniors are waiting for the seniors to see a response and hopefully see some generalist capital come into the space and buying the most liquid names. If that happens, the specialists who are kind of hiding out among the large caps will start to come down the food chain and start to invest in juniors. The specialists have been hiding out because they've faced significant redemption pressure, so they've had to stay in large liquid names. But when generals start coming in and displacing them, then we'll start to see some risk capital put to work in the juniors. And that's an existential necessity for the industry. We need that.
We're just getting through the Q1 right now, leaning on your hat with finance and your past hat, looking after a major gold miner. What do we see right now in terms of margins right now? Because that has been what has really been kind of holding back the sector.
Well, we've seen a fairly significant expansion in margins for some of the bigger producers in Q1, and so that's great. That's good news. But I think producers are still faced with the overhang of upwardly dynamic operating capital costs. So I do think that's probably overhung the performance of the equities to some degree. I think the generalists are trying to figure out whether it's safe to come out and play with the producers yet, and we'll have to see how that plays out over the course of the year. But I am concerned about inflation becoming quite firmly entrenched. I think the central banks are going to pivot and telegraph they're going to pivot on interest rates. And I think that's probably premature. I think inflation has still got another chapter or two to be told before it disappears. We don't have the latitude, or the central banks don't have the latitude they had in the 70s and 80s to really raise interest rates on a real basis to tame inflation because debt levels are exorbitantly high. Global debt to GDP sits at over 350% today versus 100% back in the 70s in the last big inflation cycle. So there's extremely limited latitude for central banks to really deal with inflation in a serious manner because debt service has become intolerable for many of the governments in the world.
Right now, though, this story about gold, though, is being driven by, which has been a surprise, it's been by huge Asian demand right now, and then also it's been central bank buying right now.
Yeah, and the Asians are doing that because they don't want to hold on to U.S. dollars or U.S. treasuries right now. They're concerned about the debasement of the fiat currencies. They see the long-term one-way trend in purchasing power of the U.S. dollar in the direction of the gold price, and they're diversifying into gold as quickly as possible, not only at the central bank level, where they're still underweight gold as a percentage of their overall reserves, but also at the individual level. The Chinese market's been deregulated for over 20 years right now, so it's very easy to own gold individually, and we're seeing massive amounts of buying at the individual level in China as well.
I want to take a detour right now, but I just have to get your thoughts right now, what's happening with copper. And then, of course, a lot of gold miners will have exposure to copper as well, too. So, gold has made a move, but copper's made a terrific move right now. How does that impact the miners right now? And also, do you see some gold companies trying to become copper companies?
Yeah, look, I think, bottom line is there's a tremendous supply squeeze on copper. Copper demand is only going in one direction simply because we're trying to electrify our economies. We're trying to decarbonize. We're trying to expand grids. We're trying to electrify all of our vehicles. That requires massive amounts of copper. That's, as far as I'm concerned, the most important battery metal, the one that's most abundantly used in the demand, in the supply chain, required to decarbonize the world. So that's leading to surging demand. But it's never been more difficult to maintain or grow supply on the copper side. We've seen Cobre Panama, the 10th biggest producer of copper as a mine in the world, shut down for political reasons. That does not make matters any better. That's going to exacerbate the supply squeeze. And there is no major copper projects under construction, and there hasn't been any exploration to engender any new discoveries, any new construction, any new pipeline projects to meet burgeoning demand. I don't know where all of this supply is going to come from. So when I hear governments wave their magic wand and say all of our vehicles are going to be electric by 2035, in what fantasy world do you live in? You have no knowledge of what's required in a supply chain to do that. So there is going to be a tremendous supply squeeze. And the fact that there hasn't been any new development tells me that the incentive price for copper has to be far above where it is today. I think double-digit territory, in my view, per pound.
Looking at M&A, it's been a great year for that as well, too. We've had the great gold prices and we've had the great copper prices, but then we look at some of these great deals that we've had. We've seen Alamos Gold and Argonaut, $325 million deal, Osino and Yintai, $368 million. And then, of course, the headline deal, of course, being BHP coming after Anglo American, but coming after for its copper at 40, which is a deal that could top 40 billion if it goes through right now.
Yeah. Well, if you're not finding it, you have to buy it. You know? And it's interesting, if you look at the gold landscape, the biggest producers in the world, the two biggest producers in the world, are the same two biggest producers in the world that were there in the mid-1990s, and they're at the same production level that they were in the mid-1990s. So what that tells me is a lot of these bigger producers, particularly in the gold universe, are at suboptimal production levels. So these are not sustainable production levels. So they've had to cannibalize other companies. They've had to absorb them in order to sustain very high production and reserve levels. And so their production and reserve levels are the same as they were 30 years ago, but their share count's grown exponentially, which is why their share prices are probably below where they were in the mid-1990s when the gold price was a tenth of what it is today. Obviously, costs have been upwardly dynamic, but it's not an industry that's grown in terms of reserves in the ground.
Talking about juniors, and you say that we kind of need this pipeline, but they've been cash starved for such a long time. And then, we've seen it's been hard to see some type of take up with the equity prices for the miners, but the juniors, it's been really tough. Right now we've seen. Looking at Ornick, though, talking about resource financings that Kai Hoffman provides us data on. He says if you do see trends, financing is not bad, but the way that the resource sector is shaken out is kind of a have and have-nots type of environment right now.
It's very selective. There are some projects that are getting sunshine and capital, but many are not. The earlier stage opportunities simply are not able to raise capital. They can't even keep the lights on. It's very, very difficult. But if you have a project that actually has economics around it, has a feasibility or pre-feasibility study, has a management team with a track record, then selectively you can raise capital. But it is not a wholesale embrace of the junior market right now. We haven't seen that for the simple reason that, as I said, we haven't seen generalists come into the sector in a very meaningful way to displace the specialists from the large cap names into the juniors. Those are the ones that we need to be buying the juniors. But with the absence of generalist capital to this point, the juniors have not seen the capital they need.
Let's turn to Gold Royalty. That's your CEO role as well as your chair role right now. It's a streaming and it's a streaming company as well too. But you have a real focus on the Americas. Why?
Well, it came about through a series of consolidations we undertook post our IPO. We raised $90 million back in March of 2021. We got a very robust currency. And a lot of the opportunities we saw were in other companies that were in the Americas that are focused in particular Nevada, Quebec, and Ontario. And over the course of 2021, we bought Ely Royalties, Golden Valley, and Abitibi Royalties. And that introduced 150 new royalties into the portfolio, focused in Nevada, Quebec, and Ontario, which is where we want to be. I mean, it's prolific geologically, and it's also low political risk and low regulatory risk. That's why perennially those three jurisdictions are in the top 5 of the Fraser Institute ranking for places to do business as a miner.
There has been some hiccups, though, that have happened in the Americas right now. So we looked at what happened with Trilogy Metals in terms of being able to get its access road, and then also what has happened in Minnesota. And then, any type of large project that you've had to develop. When I think of like Lithium Americas, or thinking of the Ioneer that has to develop their project as well with their Rhyolite as well too. It can be a challenging environment to develop a mine in Americas.
I'd say what else is new? That's mining. As long as I've been in the business 35 years, and I've been involved in the construction of 15 mines, none of them were easy. They all require increasingly more social engagement before you even put a drill in the ground, never mind build. Making that first impression with your exploration geologists on the site, extremely important. Regulatory environments become more complex, capital intensities become higher, the access to capital has become more difficult. It's never been more challenging. That's why I think there is such a supply squeeze in the metals industry. And I'm not just talking about gold and copper, I'm just talking the broad spectrum of metals. There is a supply squeeze, there's a lack of new mine development, which means that metal prices generally have to be much higher than where they are now to incentivize that kind of development.
What are some of the key assets, milestones that are going to be happening at Gold Royalty?
Well, we have 100% growth in revenue this year. We're pivoting into free cash flow and positive earnings this year for the first time, which is a remarkable achievement for a company that was a startup. It was basically something we did in the back of an envelope, a few years ago, back of a napkin at a cafe, and then grew it to now 240 plus royalties, 6 of them cash flowing, another 14 in construction. We've 60% compounded annual growth through the end of the decade. But it's coming from some of the chunkiest assets in the Americas. We have royalties on 3 of the biggest producing gold mines in North America, Canadian Malartic, Côté, and also the underground extension of Goldstrike. Those are the big drivers. And we've supplemented that with some really good project financings like on Borborema in Brazil, Aura's newest mine, which will be coming into production in the first quarter of next year. And we have a royalty in Cozamin, Capstone's high-grade copper-silver mine in Mexico. So we have quite an abundant pipeline that's really providing that growth. A lot of optionality with over 240 royalties, but I would say 80% of our value is coming from 20% of those royalties that are large, long life deposits owned and operated by some of the largest cap players in the entire mining universe.
Côté was challenged with costs. That was about a year, 2 years ago as well too. Can you give us an update right now?
Well, that's the great thing about the royalty model. We owned the royalty. We watched with some concern from the sidelines, but at the end of the day, all of our royalties are bought and paid for. We didn't get any capital calls when they had the cost overrun. IAMGOLD had to go out there and raise the capital they needed.
A bit of relief for you from past jobs, I guess.
Yeah, no, for sure. The great thing about the royalties, you're paid first, your top line, and you're really not worried about capital and operating cost overruns. That's a great thing. But as far as Côté is concerned, I think Renaud Adams is coming and taking control there. He's started the commissioning process. They poured first gold on March 31st. They announced they have 5 million tons of ore on surface ready to be fed through the mill. That gives me a lot of comfort as a former operator that the mill commissioning should go quite smoothly, because quite often mill commissionings go badly when you don't have a steady source of ore and you're hand to mouth. That's not the case in this particular mine. So it gives me some comfort that they're going to have, I think, a fairly smooth commissioning process, and then get into the higher grade ore where we have our royalty coverage.
Do we see a shift right now in terms of what the gold price is, where we have a base right now, and then we say that these are some new projects that we can kind of dust off right now? These are some projects that make sense now that might not have made sense a year ago. Are people comfortable with a new base for gold, or do we need a little bit more time?
No, I think we're here to stay. And in fact, we're not even at the all-time high for gold in real terms. If you look back in the last big inflation cycle in the 70s and 80s, gold in 2024 dollars was actually close to $2,800 an ounce. So we're nowhere near there. And I would argue that the ingredients are in place for a much more prolonged and violent upward movement in the gold price, given the debt levels that we're experiencing, and the need for central banks to actually lower interest rates prematurely and entrench inflation. And gold's reflecting that. And I think it's going to run longer and harder than we've ever seen before.
David Garofalo, thanks for your time.
Thanks for your time.
My name is Michael McRae. You're watching Kitco Mining.